So welcome everyone to tonight's the Master the Trade webinar, the last of 2020. For those that haven't been on the webinar before, I want to just show you to the disclaimer on screen that I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorized to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. So as I said, welcome everyone to tonight's webinar. And obviously a lot going on with the Fed press conference just about to start as well. So Morris is keeping his eye on that for you. So he will update you when we get to the real-time section. As I said, it's the last webinar of this year, 2020. So we're going to start tonight. We've got Nick Geach back from our New York Trading Mentor. He's going to actually explain to you what the VIX or the fear index is and how tracking the VIX can help retail and professional traders alike. Richard Adcock is then going to build on the candlestick patterns that he's been going through the last 2 weeks, and he's going to actually talk to you about 3-period reversal patterns. He's going to then hand over to Morris Pomeroy, who's going to start looking forward to 2021, and he's going to run through the top 5 themes that people are looking at now and also potentially positioning for right now. And then we'll obviously be able to analyze those as we go into 2021 and look at them further. Then, as always, if you can put your questions on the chat the minute you have them, we'll run through those questions at that time, at the end of that section. And then after that, Richard and Morris will update you on the real-time technicals and strategy for the market right now and for the week ahead. Okay, with that, I'll pass over to Nick. Nick, over to you.
Thanks very much, Chris. Good evening, everyone. Thanks for joining in. To start out, let's revisit our familiar trading screen with the instruments that a professional trader would typically be watching. And today I'm just going to take a little subset, actually 2 from the US section, the S&P Future and the VIX, and expand on the relationship a little bit more. Last week, Morris led an excellent discussion on correlated markets and how markets can impact and affect each other, either through a positive correlation or a negative or inverse correlation. And this ties directly into this evening's topic, which is the relationship and correlation between the S&P 500 and the VIX, and what useful information a retail trader might be able to garner from these products. In this instance, is actually a very strong negative correlation, and that simply means that as one index moves higher, the other moves lower. So let's start out with, what is the VIX? In broad terms, it's an index that measures the expected future volatility of S&P equity index options. And a key thing to note here is that it's designed to be a forward-looking indicator. For those of you that aren't familiar with index options, they're a type of derivative instrument, which is a tool an investor can use to hedge or speculate on the future price movement of the underlying asset, but without having to purchase the asset, the actual asset itself. So just a tiny bit of history. The VIX was originally developed in 1992 by Vanderbilt University finance professor Robert Whaley. And it was a feasibility study commissioned by the CBOE, the Chicago Board Options Exchange. And the ultimate goal was to see if it was possible to create a tradable volatility index that could be used by hedge funds, financial institutions, and other investors as a hedging tool. So from the results of Professor Whaley's research, the CBOE was actually able to create an informational VIX index, which they began to publish in 1993. Having originally been calculated using select options data from the S&P 100, it was adapted actually a little bit later in 2003 using options data from the broader market S&P 500 to provide a better sentiment indicator in order to develop an exchange-traded financial contract. And this was launched on a CBOE in 2004, and then an option contract on the future was added a couple of years later. More recently, in fact, just this past August, the CBOE added a mini VIX contract to expand access to more market participants. That's similar to the S&P E-mini. So it's commonly referred to, and this gets bandied around a lot, the fear index. Just what does this mean? When we think about a normal economic environment, markets would expect equities to steadily trend higher over time, and this would be, we'd think about this as being a stable environment and therefore a lower risk environment, or, to put it another way, a lower volatility environment. But what happens when we introduce a shock to the system, such as the events this year precipitated by the coronavirus? So investors, naturally, and investors and traders naturally become really nervous, and the future path of equity prices becomes less certain as investors are less willing to hold on to assets. And this results in higher price volatility, or in other words, an increase in the level of investor fear. So, why is it important? Here's a chart illustration of the S&P sell-off from earlier this year as the coronavirus came to the forefront. And it's, really easy to see that heading into February, we have a relatively normal environment with the S&P 500 trending steadily higher and the VIX remaining below 20. However, the collapse in global markets following the February 19 highs saw a huge jump in the VIX level, trading up to a high about a month later at about 85. And that's, a 500% increase in implied volatility. And this brings up an important point. Does the actual price of the VIX tell us anything useful? And yes, because it's a measure of volatility, absolutely. So we can think of VIX values below 20 as corresponding to more stable and stress-free periods in the markets, whereas values greater than 30 are generally linked to large volatility resulting from increased uncertainty, risk, and investor fear. And that leaves us with levels between 20 and 30, which indicate elevated levels of concern and unease. And this is where we found ourselves trading most of the time since the equity sell-off in February, March. And overall, historically, the VIX has traded within this range of 10 to, on the high side, the extreme of 85. At this point, I want to emphasize that trading in the VIX carries significant risk, as in percentage terms, the moves are far larger than in the S&P 500. However, as a market indicator for a retail trader, it is actually an extremely useful tool in helping to gauge market sentiment and understand the level of volatility and fear in the markets overall. I can use this information as an early indicator to reduce my overall portfolio exposures, so I don't get caught carrying too much risk for the prevailing environment. For example, if the VIX or fear has doubled from, let's say, 15 to 30, prudent risk management will suggest that I should be thinking about reducing my positions by 50% or about half. And this can extend to other instruments beyond equities, currencies, commodities, bonds, etc. As the VIX increases, I'd be looking to reduce my positions by some measure across the board. It actually reminds me of being on a trading desk at a hedge fund back in August 2008 and exiting our entire currency portfolio because we saw the jump in implied volatility, and it actually saved us a small fortune. So the VIX provides us with a really useful indicator and tool when we think about our overall risk management strategy. So here we've got an overlay chart of the VIX and the S&P 500 from the beginning of this year. And I just want to highlight a couple of interesting points that jump out at me, one from earlier this year and the other from what may be happening at the moment. So first, let's look back to February, to just before things blew up with the coronavirus. And we can see here that things were fairly stable, with the VIX trading around the 17 to 18 level. But both indices made extreme moves on February 24th, signaling the start of a major reversal repricing of risk. Actually ended up being a 35% correction in the S&P, as news about COVID-19 became exponentially more negative. And what's really interesting about this scenario, though, is how the indices reacted towards the end of the S&P 500 sell-off. And the VIX made its highs around the 85 level a few days before the S&P made its low on March 23rd. So it was a really great lead indicator of the S&P potentially forming a significant bottom. I wouldn't have used this information to have initiated a long, but certainly it was a really terrific indicator to consider covering shorts, or at a minimum, avoiding initiating new short positions. Bring us up to date. Since the beginning of November and the period since the US elections, we see a strong uptrend for the S&P marked by a series of new highs. And interestingly, the VIX traded lower through the end of November, but has failed to continue lower in December, even as the S&P continued to post new highs. So we're seeing a little bit of a breakdown in the correlation. And it's probably difficult to read too much into this price action. We are coming up on year end, where liquidity is traditionally lower. And then, of course, on Jan 5th, we have the US Senate runoff elections in Georgia. But it does indicate to me that this may not be the time to initiate a new long position, as market nervousness remains elevated. And if I was carrying a long S&P position, it might be prudent to consider locking in a portion of the profits that you've gained. So charting, yeah, we can chart the VIX, right? So as with the S&P, the VIX charts quite well. And here we've got the VIX and the S&P on a split screen with Bollinger Bands overlaid for both. So as our technical expert, Richard Adcock's following me on this webinar, I'm actually going to ask him to join me now for some additional insight on the technical backdrop for the VIX and the S&P, as he does a far better job of explaining the technical nuances than I. Richard, thanks so much for jumping in.
Great, thanks very much, Nick. I'm not 100% sure of that one, but thanks very much. Good evening, everybody. Hope you've had a great week so far. Yeah, I mean, I think the important thing to bear in mind when you're sort of studying the VIX on a technical perspective is that you can still use the same types of indicators that we do on other forms and other markets, and you can still use exactly the same techniques and signals. In fact, what I like to do is to have a chart like this where we have the VIX and the S&P on the same chart, and then run Bollinger Bands so that we can see the type of volatility that's coming into the fear market, and that can often show you or give you earlier signals of when we need to be watching the S&P closely, or when we fail to see sort of confirmation of new trends developing in the VIX. So most recently, a few days ago, we started to see the VIX Bollinger Bands, for instance, beginning to widen. Now that, as we know, is the potential sign of volatility coming back into Bollinger Bands, so the bands start widening, and that could result in further upside scope. So as we've seen previously, when the bands have started to widen, we've seen the follow through and more volatility coming into price movement. It's this that would then lead me to look at the S&P and see if we start to see, obviously, the inverse signal, where actually recently, a few days ago, we haven't seen the same sort of follow through in the S&P as we were perhaps beginning to see within the VIX, and with the expectation of more concerns developing within the S&P. So I would just tend to use one to confirm the other. And as Nick has said, we can often see the VIX lead and give earlier signals. So by incorporating technicals and Bollinger Bands, we can actually zero in on the areas that and the time frames that we need to be monitoring the S&P more closely for the potential of turning points. So it's very useful to use technicals on the VIX as well as the S&P. So that leads me on to look at the next technical section. Now, over the last few weeks, we've looked at candlesticks. When we first looked at them, we started to look at candlesticks as a help and an aid to judging sentiment, and when we're likely to start to see sentiment changes. We've then built on that to look at the actual one-day reversal, one-period reversal patterns within candlesticks. Last week, we looked at the two-day period patterns. And this week, I just want to look at the three-day reversal patterns, which can highlight more significant shifts in sentiment because, believe it or not, they take a little bit longer to form. Now, obviously, when you look at the traditional types of patterns like the head and shoulders, the double tops and double bottoms, these can take a prolonged period of time to form and actually won't be confirmed until you start to break above or below the neckline of the reversal pattern. Now, the beauty of candlesticks is that they give us a much faster shift in sentiment. So they give us a much earlier warning signal. And quite often when you see a traditional head and shoulders top, for instance, there will be a candlestick reversal actually on the head. And that will be the first sign that something's changing. So it's well worth keeping in mind the types of reversal patterns that we've been looking at. Okay, so what do we look for with the 3-period patterns? Again, these are very similar to the 2-period patterns in that we still see the same sets of criteria developing within that price activity. The first one is that the first period of the reversal pattern will just look to be a continuation on the ongoing, in this case, positive sentiment that's in the market. We're seeing standard lines and we're continuing the ongoing uptrend that's in place. So effectively, at the close on the first period, we would still be thinking this is still a bullish trending condition. I want to stay long with the market, and the risk is that we can continue to move higher. The first warning signal, as with any candlestick reversal, comes with the opening of the next period being above, so we leave a gap from the first day's closing level. And it's this gap that is the warning signal of price exhaustion. The positioning is getting skewed too far in one direction, i.e. to the long side, and that's when the market is most exposed to a reversal and a more significant sell-off. Now, when we looked at the bearish engulfing pattern last week, the second period of the reversal pattern gapped higher, made a new high, which is exactly what happens with the pattern that we're looking at now, which is the bearish evening star pattern. But instead of rejecting on this second day and selling off and closing below the first period's opening price, we actually start to see a smaller open close relationship. So the real body of the candle is much smaller. And as we know, once we start to see declining sizes in real bodies of candles, that reflects the potential of a sentiment shift. So instead of getting the earlier signal of the rejection and close below the opening price of the first day, we see a small range on the day, and more significantly, a small open close relationship, small real body. Now, having seen this gap higher, to protect our long positions, which hopefully we've had within this bullish trend, we would pull stops up to just under the opening price of the first period, because we know that if the market sells off and breaks that level, we have the risk of an engulfing pattern and a more significant sell-off. However, once we start to see this small open close relationship on the second period, we would keep our stop at this level, or we may even move it higher to just under the midpoint of this first range, open close range. Because if the market then sells off, puts in a negative candle and closes below that midpoint, we would complete the bearish evening star pattern. So in other words, we've seen a negative sentiment shift. The risk is that having seen the gap higher, small open close relationship, and then the third period seeing the negative sentiment and rejection developing to close under this midpoint, we've seen a developing risk for a much more extended sell-off to occur. Now, with the 3-period patterns, we don't need to see confirmation. So in other words, I wouldn't need to see a fourth session where the market closes lower than its opening price to confirm the sentiment shift. It's the fact that the close has developed below this midpoint that will actually prompt the new sell signal and suggest that the downtrend's in place. So we need to be short on the confirmation of this reversal as the market comes into the close below this point. So we would have been stopped out as the market either closed below this level, so we would have reversed the long to actually go short of the market as we saw that confirmation of the reversal pattern, or if we'd moved our stops higher for this third period just under this midpoint, we would have been stopped out as the market traded off and then gone short as confirmation of the close below that midpoint started to be seen. Now, the bullish pattern within the 3 period is the bullish morning star pattern. And again, it's the exact mirror image of the evening star. But in this case, we're trading in a downtrend. We're continuing to see bearish standard lines. Again, the gap is between the first period and the second period. It's that gap that flags up that the potential of a sentiment change, the potential is that the market is exposed too short to the downside, and that's when the risk is for the market to recover and correct against those downside extremes. We put in a small open close range, so a small candle with a small real body, followed by the third period that rallies and closes above the midpoint of the first open close range. So it's this activity in only 3 periods of whatever chart you're looking at, whether it's an hourly, 4 hourly, a daily, or a weekly, it's this 3 period activity that sees the sentiment shift and the risks of new, in this case, bullish trend developing, reversing the previous downside move. Now, again, initially your stops on new long positions in this case would be placed just below this low, and then we would look to move that higher as we're able to see more positive themes beginning to develop. Now, on the second period, you can actually see a more significant shift in sentiment signal in that instead of the market either closing higher or lower than the second period's opening price, we actually put in a doji pattern. So we form what's called a bullish doji star reversal, in that we're trading in a downtrend. Again, the first period is just a normal continuation of the bearish sentiment, but the gap lower results in a doji. So we close and open at exactly the same level within a relatively tight range for the whole period. It's then followed by an opening price, followed by a strong rally to close above the midpoint of the first period's open close range. So again, the significant sentiment shift is then signaled by the doji pattern with the confirmation coming from the close above this level, and that would then be the trigger for a more significant upside move and to trigger buy signals. Now, quite a rare pattern, but very strong if seen, is what's called the abandoned baby. Now, this is where, if in traditional analysis, there's a pattern called the island reversal, where you gap lower, put in a tight range, and then gap higher, and then start to rally. Well, on the abandoned baby, the second period again is a doji pattern, having gapped lower from the previous day's or previous period's closing level. But then the third period reflects a rush to get into the market. So for whatever reason, sentiment's changed and the market suddenly wants to see nothing but buying coming on the open. So we gap higher from the second period's closing level, and we leave this doji pattern on its own. Now that's a very significant shift in sentiment and a very strong reversal signal to develop a more positive trend. So by using a combination of the 1, 2, and 3 period reversal patterns and using one-day candles as an indication of sentiment, candlesticks can give you a very strong feel for how the market's trading, whether we're going to continue that ongoing trend with the formation of standard lines, or we start to see the reversal activity developing, and we can actually use that with very significantly within day-to-day trading, looking for more significant trends once we start to see the criteria of these reversal patterns met. So that's the candlesticks. That just leaves me to hand over to Morris, who's going to look ahead to 2021. Thanks very much, Mo.
Thanks very much, Richard. Welcome, everybody. I think extremely interesting point of the year here, but I think also a lot of people are keen to know what we're going to be looking ahead to And this is the time of year we need to start thinking about not only the impact of year end, but into first quarter next year. So I think with that in mind, we're going to spend a few minutes sort of looking at some of our sort of major issues of the moment, if you like, and whether these will extend into the new year. So what we've done is we've had a little bit of fun with some of the graphics here, but we're going to sort of count down my top 5, if you like, the top of the pops. And at 5 we have modern monetary theory, MMT. Can it work? Now, very briefly, and it's a very deep subject, so I've got to be careful not to spend too long on this, but if you haven't heard about modern monetary theory, or MMT for short, by now, you soon will. It's highly likely that MMT will be increasingly touted by economists and politicians from both sides of the aisle as the economic prescription, even panacea, to cure our economic ills. Now, what does that mean? Basically, we have a situation where a country that controls its own currency, i.e. the central bank and the government, if you like, can actually print money. Now, if they can print money, they can get interest rates extremely low, which means governments can spend ad hoc, if you like, or willy-nilly in huge amounts. And, even if there's not enough foreign buyers to buy that debt when they've done it, the central bank can print the dollars and buy that debt from them. So although it sounds like it should be totally illegal, and a lot of the central banks aren't actually mandated to do so, it's called monetizing debt, but it's what happens. So, as the government keeps spending and keeps printing dollars to find, or their currency, to finance that spending and pay for debt, basically in a crisis like we've got now, it makes a certain amount of sense to try and bridge the gap until the good times. The problem comes is when we get the good times and they don't pay the money back. So we just get these excessive debt spirals continuing going on. So what can be the threat to that? It sounds too good to be true almost, but this is what we're seeing at the moment. But there are threats to this. Now, one of the things that can really kill all this is actually inflation, which, if you remember rightly, and if you were listening to Jay Powell on the Fed tonight, speaking again about trying to sort of stimulate markets to generate inflation, one of the things that can topple this whole theory down is actually inflation. Now, many people say if we get inflation, that means we've got growth, so therefore that would be okay. We can control the inflation because we've got growth. It's a natural process. The problem is that you can get stagflation, and if we get a situation where we have little growth but rising prices, then we have a problem, because the Fed, would they have to raise rates if we've got inflation pushing through 2%? Probably not. What about 3%, 3.5%, 4%? Then they are not going to be able to stay still. And if they raise rates and there's no real growth, then equity markets will probably collapse. And this is the problem they've got themselves into. So we need to be very careful with this. It sounds a great idea now. The problem comes if we get a very strong recovery. Now let's assess the situation that we get a vaccine in place, distributed into the spring. People see lockdowns finishing. We get this pent-up spending release, if you like, from the consumer. We already have very high commodity prices. Now, these prices feed into consumer prices over time. So we could see a consumer prepared to pay up for higher prices. You'll get inflation. So we need to be very careful about this. It's a very popular theme at the moment because people think interest rates are going nowhere for 3 or 4 years. We are not 100% sure of that. We also have to look out and see why the economic recovery letters matter. If we get a V and even a U or even a K, it works. What we don't want is to sort of see us fall back in the new year, get this massive push back up into the spring, where we get this pent-up spending go, because there is a danger we get inflation, but we don't get the growth that goes with it. And that's what we've got to be very careful. Modern monetary theory is adopted by populist presidents and populist governments. It started with Trump. He cut taxes, he spent massively on cutting taxes and infrastructure and giving away, make America great again. That's all very well, but in the good times, it's supposed to be paid back. He did that when America was booming. So that is a concern. So, you know, this idea that you can use it on all terms is not true. We need to be very careful about this MMT theory and whether it can last. It only works when interest rates can be kept almost at zero. So that's something I think is going to be playing on our minds as we go through. Sorry to start on such a down note. Let's have a look at number 4. Number 4, I think I'm looking at the emergence of cryptocurrencies here, and it's quite timely as we burst through 20,000 today. You know, it's taken off. So what can you say about Bitcoin and cryptos? I got a good question. I'm struggling to understand why they go up. The problem with cryptos is they don't actually have a fundamental structure behind them. So, you know, is there something, I mean, you can't make jewelry out of them. You can't make anything out of them. It doesn't come out of the ground. I mean, you know, we have this stuff that is there. So yes, as long as people keep, you know, suggesting it's going up, maybe you get people speculators that buy it. But I'm struggling to see a reason why it goes up apart from supply and demand possibly, which is what some current commodities do. But the problem is that it's not traceable, it's not regulated, and has a horrible habit of disappearing. So, you know, it is difficult. But the thing with crypto at the moment is that with some of the bigger ones like Bitcoin, we are getting a few more mainstream smaller funds or some of the funds starting to look at this. And I think what they're worried about is this does become something in, say, 2 or 3 years time, where we get a more general structure, a safer structure to it, where you can trace it, you can, you know, it's less hard to hack into. And people kind of feel like it may be the new Apple, you know, in the early days when no one believed Apple was going to be anything and stocks were, you know, a few bucks a share. And so I think some people have taken a massive risk reward, and I think they've got tiny on the portfolios, and I think that's what we've seen here. And this run up, even at the expense of gold to some degree, I think some people are beginning to feel that the future, maybe in 10 or 20 years, is digital currency, and it may well be. But the risks are pretty high at the moment. So I think we've got to be careful of that, but it is big news at the moment. So that's number 4. Number 3, going into next year, current theme at the moment that's hitting everybody is the recovery story. And we all love a great recovery. Markets are forward looking. You know, they're sort of potentially looking at a danger of inflation. If you look at the chart on the right here, this is US inflation expectations. Now take a look at that. You know, inflation expectations in the markets are beginning to pick up. You know, this has implications for everything. Now, with the weaker dollar that we've got at the moment, and let's face it, we are trending lower. If we look at that is something that supports commodity prices. We also have one of the biggest fiscal push inputs, if you like, since World War II. $23 trillion of global liquidity in the system as well. And this liquidity is rising every day. The market is being pumped like crazy into financial markets. Money supply is going through the roof, but that money supply lacks velocity. Now that means that the money supply is going into inflating financial markets, but not inflating the economy, because the man on the street is not getting those funds. They're not getting that money. People have done all the borrowing they need to do, and if rates go from 0.4% to 0.2%, it makes no difference to their borrowing costs, because the banks aren't going to go negative with lending, and nor are the mortgage companies. So, you know, we've hit that lower band where lower rates mean nothing more to the man on the street. And so we've got to this structure where that amount of liquidity, the danger is, if we do get a recovery, that money velocity does start seeping into the consumer, who becomes more confident, prepared to spend more. Now, we have got the first time in 100 years where we've got household savings, particularly in the US, going higher in a recession. Now, that threatens the fact that we may have pent-up spending when we come out of being locked down. So higher consumer prices are a concern into 2021. That sort of forward-looking inflation indicator is beginning to unnerve a few people in the bond markets, and could have implications for financial markets like equities if we start seeing that go ahead without great growth. We've already seen commodities surging forward. So, you know, central banks have created this monster of money supply, free money, cheap money being thrown right into the markets, but they're ignoring what the longer term implications of this could be. If this money starts coming out of financial markets and into the pockets of the consumer, then we need to be careful. And it is a risk that the Fed at the moment is not even worried about. Now, the Fed again tonight just suggested that they were not going to be doing anything for ages, even if they see inflation start rising. So we got the first threat of inflation just coming at the same time, where central banks are thinking they're going to ignore it for a while. So something to be aware of into 2021 there. Number two, yeah, I think looking forward on this one, higher global equities. How high can they go? Well, with the amount of stimulus we've got in the markets, one would suggest probably a bit further. What's going to nudge this away is difficult. This is the NASDAQ you can see in front of you. Opened at 2020, opened in 2020 at 88,754. A high of 12,672, not a bad return in a year, 45%. I mean, beat that. I mean, this is just stellar performance from the lows in March. Again, driven by massive liquidity from central banks, particularly the Fed. The Fed is talking about not going anywhere, more stimulus, 80 billion a month still being bought in treasuries. So, you know, they're keeping the fuel on the fire. So I think if we do see a dip, and there is a danger into year end that we see something of a liquidity issue, that maybe a bit of book squaring, we may see a 5% dip, maybe a 10% dip, but I do think there's a queue of people still waiting to buy this stuff, not necessarily the NASDAQ, but I think what we're seeing is a rotation now. A part of the recovery trade that we're talking about means that we're probably looking at more value stocks rather than tech. Big tech has probably, you know, had its run, and I think, you know, the lockdown or the stay-at-home stocks, if you like, were sort of really strong then. I think coming out of that, I think it's going back into the longer-term value stocks like travel, leisure, and the rest of it as we unlock. So I think with that rotation in place, it keeps general markets fairly well bid. So the only thing I do have a problem with is the market is extremely long at the moment. If we look at all the surveys, it looks like a lot of funds are all in. Looks like a lot of cash on the sidelines has been put to work, a lot of it into equities, but also commodities. The question is, with this massive leverage and the amount of call option buying at the same time, which is more leverage in short-term options, can this continue? So it could be due for a clear out, but I do think there is still a market waiting to buy a dip because the Fed is behind everything and is continuing to pump liquidity in there. So yes, you can see on this chart, we can get some nasty reversals. So let's have a look at number one. What's the main thing going on at the moment that we think is going to pursue into or continue into next year? And I think for me, it's a dollar downtrend. We are trending quite nicely at the moment. We are going to have hiccups to this. Don't ever think that foreign exchange moves in a straight line. It rarely does. But you know what we've got what we've got in front of us here is quite a set in stone trend down. I'm struggling to see what's going to change that. I think the central bank remains extremely dovish, and I think whilst they're still ploughing into buying treasuries, I think it's going to keep rates at the short end very low, which is debasing the dollar, if you like, and I think that is probably going to continue. Now, the impact of this is it impacts so many markets. It's probably bullish for emerging markets. I expect to see further rotation into Asian markets, which have done very well this year. I think the dollar is sending commodities sky high. It's helping gold rebound. It's helping crypto to a degree. People are getting worried about, you know, how massive the manipulation from central banks is. And currencies being debased. You know, this whole fiat currency system, if you like, you know, if you're not sure what that is, please look it up. You know, fiat currencies are sort of based on faith, nothing more. If we ever lose that faith, then history is full of what can happen with that. So I think the dollar downtrend could continue next year, certainly until the central banks have a change of heart. But I think one of the things we've got to be careful of is inflation again there. But you know, this is actually adding fuel to that argument, and I think this is also helping keeping equities bid as well. So that's a big play, the dollar. I think it could go lower. I think what it does is lifts all boats. But one thing it does do, it raises currencies prices in countries that can ill afford it. So I think there could be a bit of a backlash to this, and we may see some intervention next year in certain currencies where the central banks are prepared to do so. So it's an interesting start to the new year. I think it's an interesting finish to this year, and I think we've got a lot going on. But what we can do is look at where we are right now. That was my top 5. We'll go back to our usual real-time update in markets right now, and look where we are at the moment. I've just been listening to Jay Powell at the Fed, not saying a great deal new, a few bits of tinkering, nothing else, but just committed to his policies, and also calling again on the US government to start more fiscal policies. So I think we're going to take some questions now. Is that right, Chris?
That's right, yeah. And I've got one for you as you're on, so that's perfect. So somebody was asking, the liquidity due to the MMT that you were talking about, in their view, was making trading Forex potentially unattractive. Do you think that you can make money with Forex trading if MMT continues into the future for a while?
Well, MMT is not about foreign exchange markets and liquidity. MMT is about the policy of borrowing. So MMT is more of a government tool. So basically what it is on the fiscal side of the equation. So MMT allows them, with rates low and printing money, allows them to borrow and work on infrastructure. You've seen Sunak in the UK spend a huge amount of money trying to bridge this gap until we get a vaccine. We're seeing it in the US and Europe. This is borrowing cheap money, but they can finance it through their own central bank. So it's about having control of your own currency. The liquidity issue is directly from the central bank, when they're printing money. And it's been going on for before I was born almost. I mean, they've been since 1971. When we came off the gold standard, they've been printing money, and in fact, they printed money before that as well. So, this idea of printing money to sort of finance governments has been going on for a long time. So, yeah, you can make money out of foreign exchange. You may need to sort of you have to remember foreign exchange is not easy. It doesn't move in straight lines. You need to look at your technicals. You need to do a lot of reading. It's not an easy asset to make a lot of money out of, but it's very satisfying when you get it right. If you don't trade bonds and a lot of equities, it's very different to equities, but it is a fascinating market because there's so much of it. It's got so much depth.
Do you think, Maurice, that we're potentially at the end of the? I mean, we've had a very the currencies move in cycles, don't they? And the dollar's up and down, and we obviously the dollar's had a really good run in the last X amount of years. Is it potentially that people are looking at this as that change of cycle, and we're going, we do see these waves over time?
I think there is. I think, there's a couple of things that have helped as well. I think we've got this joint bond situation where now we've got a bit more unity in the EU with, sort of dealing with crisis on a joint basis by issuing joint bonds. I think that's made a bit of difference. I think the EU, all right, it's got problems with Brexit at the moment, but it is a pretty powerful house. It's generating it's a massive consumer base as well. And also I think you've also got to look at the emergence of China and Asia. I think Asian market's going to do extremely well in 2021. And, Asia is breathing down the neck of the US as well, China in particular. And I think we are possibly in a fundamental change over the next 5 or 10 years of what that means. I'm not sure it's going to be pretty necessarily, because I think the US will kick and scream against that. But I think we have got a fundamental change coming, and traditional methods, I mean, correlations also come and go, and I think you've got to be careful that you don't get married to an idea of, if we see this, then that's going to happen. These things evolve. Dollar yen is not the safe haven we used to see, and we're not seeing the same correlations between many things that we used to see. And I've seen times when we've seen stocks go up and the dollar go up. Now we see stocks go up and the dollar goes down, and these correlations change. So we have to learn and educate ourselves on a regular basis. So keep reading and keep trying to understand. I learn every week.
So Maurice, somebody was asking, you've got places like Zimbabwe and things where they've had massive hyperinflation. You talked about this sort of MMT, where maybe Japan's done QE in the 90s and it didn't work. Why do you think the Western governments think their economies will react differently? Do you think we're going to see a change in market structure?
I think what it is that Zimbabwe is not the US. You know, the US can get away with this because they got the global reserve currency. They got a massive bond market. Zimbabwe doesn't. EU the same, big bond market. They've just got a way of actually managing this a little better. Not that that means there won't be necessarily any accidents down the way, but the problem is we also live in a world of populist governments, and populist governments have got to keep delivering to what their voters want. And that usually means spending money on more benefits or making things better for them, otherwise they won't vote for them. So they keep spending. And the problem is in the good times, you know, we tried to balance the books in the UK many times, and Thatcher did it, and it was very painful. I'm not sure populist governments want to pay it back anymore. So we are. Your questioner has been correct. We are borrowing from the future. I think our children, or in my case, my children's children, will probably turn around and say, "What on earth were you doing? Thanks very much. You've destroyed our future." But yeah, I mean, governments don't care. They won't be around then, and nor do central bankers, and they're not even elected. So yeah, they're taking huge risks here. How that ends, I don't know. I can't imagine it's going to be good, but you know, maybe we will get 5%, 10% growth again. Unlikely in the Western world, but yeah, it is a concern, but it's not for now, I'm afraid.
Okay, so some other interesting questions as well. So with a possible continuation of this dollar downtrend, if you're a UK investor, what's the best course moving forward? Would you say that maybe avoiding companies where a lot of their earnings are in dollars would be a positive?
For me, I'm a great believer that you know, if we get this Brexit deal done, then I think we will see foreign capital inflow come into UK assets. So the great thing is you can buy UK assets in sterling if you're a UK resident, obviously, and you haven't got a currency risk. What I would say is I think that the FTSE 250 is probably a better bet, and stocks within that rather than the index. I think you've got to be a stock picker now, and I think realistically that does better because of the fact that the FTSE 100 does have a lot of companies in it that are currency sensitive. And you know, if we are going to see sterling rise, then I think that's going to hit some of those big exporting mining, petroleum companies and mining companies pretty hard. So, but there is, you know, you've got to look at things at the moment where UK assets are probably some of the cheapest out there on a value basis, relative value basis anyway. And I think with some of the uncertainties removed and vaccinations already taking place, then I think UK assets may look very attractive to many global asset managers in the years to come.
So I know you sort of talked about Brexit a little bit there, and I know you cover it in the next section, but someone had a question, so you know we might as well bring that question up now. It seems that the deal is going to be done in some form. That's what we're sort of getting again, although we have had this sort of on-off before. Could you give us your view, you know, if Brexit deal is done, what's your thoughts on euro dollar and cable or sterling dollar,
Yeah,
you know, in the short term at least?
Yeah, it's a good question. In the short term, I would say I think a lot of people have been buying sterling against the dollar because they've got both the hope that the Brexit deal gets done, and we've seen quite a bit of dollar underperformance as well. So the one to be in has been cable, if you like, sterling against the dollar. I think a fair bit of that is priced. I'm not sure it's necessarily priced that much against the euro, though. We're still above 90 cents. You know, I think there's room for that to fall a little further. But I do think that, you know, if we do get no deal, I think both could probably go down a little bit. I don't think it's great for Europe. I think Germany and France, their auto sectors would get very heavily punished if we ended up with no deal. I think you'd see, you know, maybe some European foreign capital leave the EU looking for pastures greener whilst that settled down. So they both could fall, but I think on a deal, I think I'd probably be more prepared to sell euro sterling than buy sterling against the dollar initially. But then I think if you know, I would be a buyer of sterling against the dollar on a dip. I think we have priced a certain amount of that in, and the other thing is exactly what kind of deal we get. You know, some people do say that the sterling rally may be very short-lived if it's not a very good deal, and that we are still manacled by some of the EU laws. So we need to be careful of that. I would be careful of, you know, this buy the rumor, sell the fact issue that we may see. if it's not perceived to be a particularly good deal. But the headline will take sterling higher, certainly in the short term.
So really, you obviously you spoke about inflation quite a bit, and that's one of your big themes for the new year. So somebody was saying, why do the US or what the Fed, why do they have a 2% inflation target if it's, you know, if inflation's bad?
Yeah, well, it's a very good question, because they haven't hit that inflation target for about 5 years. You know, it's all very well having a target. It's like having a budget. If you don't reach it, well, so what? You've just set a number. I mean, that's what it is. I mean, they believe that is the right sort of area inflation should be, not too hot, not too cold, Goldilocks, if you like, that sort of keeps growth and real rates in check and promotes steady growth and the perfect level for stimulating the economy going forward. Whether that's true or not, who knows? But even with all the stimulus they put in, and Japan has put in, and the EU have put in, if we look at the collective balance sheets there, they have produced, and their track record for producing what they've set out to produce is absolutely appalling. They haven't met anywhere near their targets so far. And it will be interesting to see what happens if we do actually get some inflation, which may not come. And if we do get it, it may be short-lived. But the problem is that, you know, the way that modern economies are run at the moment is very difficult to get productivity up. And, you know, I think almost central banks have actually added to the problem of generating higher productivity in these economies, because we've got zombie companies that are worthless being able to survive. Capitalism, as it's supposed to be structured, is not allowed to work properly, and we're not having these cleansing recessions where companies go under, we get someone come up more entrepreneurial, sets the company up stronger, we get better productivity, and on we go, and we build and we become stronger. Central banks are actually stopping that natural process happening, and whilst they won't admit that, I think that's a fact, and realistically, I think that's keeping productivity down, and so getting any sort of longer term inflation is going to be very difficult indeed.
All right, brilliant. We just have one question for you, Nick. Obviously, you're waiting patiently there from the start. Somebody just wanted you to confirm that if the inverse correlation, so VIX will go higher as the S&P goes lower, and obviously vice versa, the S&P goes higher and the VIX goes lower. Can you just confirm that again?
Oh yeah, absolutely. Because the underlying instrument is the same, right? It's the S&P 500. So yes, as the S&P goes up, the VIX will go down. As the S&P goes down, the VIX will go up, because they are an inverse relationship.
Okay, and we saw that on one of the charts there as well. Do you think, as a retail or professional investor, it's you know, why would you position in the VIX, or you use it more as an indicator to say, okay, like you said, we're coming to the end of the year, the stock markets are at all-time highs in the S&P, but yet the VIX isn't going back below 20. So obviously there's a bit of nervousness around the end of year. So maybe, you know, it's more of as an indicator rather than taking a position in VIX.
Yeah, I'd agree with that. It's a difficult instrument to position in for the individual investor. It's more of a hedging tool. Certainly not as a speculation tool. I wouldn't recommend it. It gets really volatile, and the problem is if you take a position in it and something goes wrong with it, it becomes a very, very expensive trade very, very quickly. It can be used if you do have an extensive equity portfolio. Yeah, you can use it as a hedge in certain periods. If you're a little bit nervous, yeah, you can absolutely. If I've got an extensive long position in equities, I could absolutely think about buying a little bit of VIX as insurance, effectively. And that's more the way I would look at it. But to me, for the individual investor and a retail investor especially, it's just a gauge of what's going on there, and it alerts you to potential risks coming out that maybe you haven't seen or read about, and the VIX will reflect that for you.
All right, brilliant. Thank you very much. So with that, we've given Maurice a couple of minutes break. Maurice, you're back on real time.
Okay, thanks, Chris. Right, everybody, let's see where we are right now. I think a couple of things that are going on. I've highlighted a couple in bold here, but do have a read through the list here. Germany going into hard lockdown. Merkel saying the authorities were forced to act. Makes you wonder whether everybody else is going to. She's taking Christmas away from a few. I mean, I think they're just going to be open for a day or so. And the Netherlands, Italy, UK, US announcing threatening further lockdowns. I think we probably will be after Christmas. Now, the thing about this is that it does hit economies and it hits them pretty hard. And at the moment, I think equities are totally ignoring that. Everybody is looking forward to the vaccines curing everything. There's a couple of things about that. Vaccines don't cure unemployment. And the other thing is that, you know, these vaccines are not going to be hitting their massive target just yet either. And it's that bridge between, well, it's that gap between now and when we are past this that worries me. And in the middle of that, we could, you know, through these lockdowns, see quite an economic impact and further unemployment. And that is still an ongoing concern, which I don't think is priced in equity markets at all. I think the tech companies are under a little bit of pressure. I mean, we're seeing a rally today on the back of what Powell said or what he didn't say, sticking to his guns. But there is quite a lot going on with regulators around the world. And I think this could be something that could be a little destabilizing for this massive run up, all-time highs that we're seeing on the NASDAQ. You know, the problem is these things do take quite a while to get through. But when we're seeing China, the EU and the US itself looking hard at these, it does make you wonder whether that we could be near a top. But again, at the moment, it does look like, you know, the Fed policy is still driving these higher. And, you know, they're big companies. They're very, very professional companies. They're cash rich. Investors like them. So, you know, it's hard to fight. Again, I think there's buyers on the dip, but I'm just wondering if we could see the regulators one day come out with a headline and these take quite a tumble. Also, I think we've seen some preliminary PMI data. We saw a very strong rebound for France and Germany this morning. The services recovering strongly, which is what we've been waiting for. We've seen the manufacturing going okay. Services has really struggled, you know, everything the consumer uses. Powell was talking again tonight about the retail sales in the services sector has been poor, where you have customer facing because people are not going out. And so this rebound in services is pretty important. Be interesting to see if we get more of this. The US was not a bad print at all today. So, you know, data from the US was mixed, you know, retail sales being poor and service PMI being okay. So, you know, that retail sales were not only poor, they were a bit of a stinker, to be honest. And I think realistically, it flew in the face of some pretty strong credit card data we've seen. So it's a bit confusing this, but there was a bit of a revision up from last month. On the central bank and political news, you know, we've got rumors of a slimmed down US relief package, possibly this week. I think Schumer and McConnell were both asked if they could get a deal done by Friday, and they said that they were very hopeful of something. But the thing is, this has gone down from, you remember Nancy Pelosi walked away from a 1.8 trillion deal with the Republicans, and now that looks like there's a potential $748 billion proposal. That's not enough, to be honest. It's just not enough. But there is a belief that once Biden gets sworn in, then he and his party, depending on how powerful they are in the Senate as well, may be able to get a larger package passed. So that, again, hope. And I think US stocks are actually higher over the last couple of days on the hope that this does get passed this week. It's a stopgap towards the next one, because the thing here is that a lot of these packages that are in place at the moment expire on December the 31st. We're hearing more from Commission President von der Leyen saying there's a narrow path that's open for a deal. We're not there yet. You know, it's a very narrow path, but, you know, she does feel that we're getting there. There's a few things that have been broken down. The market has swung from thinking that, oh, blimey, that, you know, it was insurmountable differences to, well, you know, it looks like both sides definitely do want to make this happen. It does seem that Boris is under pressure to get a deal, otherwise he would have walked by now. And so now we're thinking that maybe we do get a deal. Still nothing structured in place, but they have made some strides. Some fading of the red lines, if you like, and maybe someone might just step over a couple of those, if they think they can get away with it politically. So we're back on thinking or hoping that we're going to get a deal, and we should hear something possibly by the weekend. The Fed rate decision press conference is still going on, just finished actually, I believe. Nothing really new, but committing to staying where he is in policy. Rates are going nowhere. These guys are very concerned in the short term about what's going on. And then right at the bottom here, we've got Georgia Senate runoff, 5th of January, big event coming up. Got to keep an eye on that. And in between there, just look out for headlines on the relief package. So that's where we are. I think one of the interesting things that we need to look at is this continuing trend higher from China data. We're seeing some pretty strong industrial retail sales data. The economy is recovering. It is the core of global recovery strength at the moment. And I think money is flowing that way. We've seen strength in the offshore Chinese currency, the CNH. And I think a lot of money is going east, and I think that's another reason why the dollar's a bit weaker. I think that the upside seems to be far greater in Asia than it is in the US, with all-time highs already in many of the markets in the US. And I think markets are, investors are looking elsewhere, and I think this could continue. So whilst China, I think it's worth keeping an eye on the data. If we start seeing this roll over, then I think that could be rather dangerous. We need to make sure that the recovery in the EU and the US and the UK is strong enough to support demand to allow China to continue to do well. But we still have ongoing issues with US trade tensions there, and also China and Australia with their trade spat as well. Interesting, I wanted to show you this chart, markets Brexit positioning. It's titled Raring to Go. Gilt yields, I mean, they're 10-year UK bond yields. So as we got this change in sentiment, we saw jump in yields, we saw a jump in sterling, and it just shows you how sentiment can change pretty quickly on a couple of tweets and a couple of statements. But we're back on the belief that we're going to get a deal done now, and that's sort of changed everything from the bond markets. And interesting enough, I think bonds almost led that. So again, it's one of these things about sort of keeping an eye on other markets when these things going on. But these were headline driven really, and again, it just shows you how quickly some of these markets can move. So that's Brexit and the positioning there. I think all of us are concentrating on these specific subjects at the moment, and that gives us a good idea, a good setup to sort of then start considering where we go next. So looking forward at markets, I'll put a few things down here. I think it's worth looking at most of these very briefly. Certainly since the last Fed meeting, the outlook has improved. A lot of talk from Powell tonight about the vaccine and its potential, but we're not there yet. He kept saying that, and we do need more fiscal stimulus to bridge the gap. What happens for the UK on assets now? A deal this week? Well, I think there's a potential for that. More talking, I think there's potential for that as well, because the Europeans love talking. So I'm not sure if there's going to be enough time for them to ratify the deal. If they do get a deal, they may want to delay, and on we go. That's the way they do it. No deal is moving to the background a little bit more. If we do get a no deal, just look out, because sterling's going to take a nosedive if Boris actually is brave enough to walk away. But again, why hasn't he gone already? Global equities, especially those in the US, continue to ignore many risks. I mentioned that earlier. Keep an eye out for year end. I mean, we do run into year end illiquidity issues, and that sometimes can be a concern. Some of the big boys don't get out, but some of the smaller funds do. So there's a potential for some profit taken into year end, and I would say that's probably going to start towards the end of next week. So just be careful of that. It may just sort of tip things over. Real-time COVID issues. I mean, these lockdowns, I think, are going to make a difference. And what the lockdowns do is hit the psyche of the consumer. The consumer is fed up with being locked down. They can't do what they want to do. They can't go out, and their whole attitude towards things. And also, some of their friends are losing their jobs, and you get a breakdown in consumer confidence, a breakdown in spending. Having said that, we are still seeing pretty substantial spending online, and unfortunately that is killing the high street retail sector and the big malls. So I think that's going to stick. So I think we're going to see a massive change on the high streets, and a lot of businesses going to go out of work, out of business, and that probably means more unemployed, I'm afraid. So as I say, a vaccine can't cure that. Currency markets, if we do see a wave of profit taking, the way the correlations are at the moment, that will probably see the dollar higher. And remember, the market is pretty short and pretty bearish, so that could be an issue for the dollar if we do see a tip over in the stocks. So keep an eye on that. The dollar hasn't really moved a great deal today. In fact, it's a little bit weaker as I speak. On the Fed sort of sticking to their guns, there's enough stimulus in there to keep it going. They're not talking at all about doing anything for a while on the upside, so it's all downside for them at the moment, and that seems to be sort of keeping the dollar under pressure. So it'd be interesting to see where we are in sort of February, March. Further lockdowns hitting the euro, potentially, yes, but at the moment, the dollar is the driver of everything at the moment. And we've seen this breakout on the euro above 121.77, which we took a long time to break. We are above it now. We need to consolidate above here for a while, but it does feel rather pedestrian when euro moves. We get a move, then it seems to stop, but we are breaking out of some pretty interesting levels across the board on the dollar, so I'm sure Richard will talk about shortly. So at what point does a weak dollar spur other competing nations to complain? Well, funnily enough, I wouldn't be surprised if we saw Australia, Switzerland, Japan, and possibly the EU start spouting about the strength of currencies. We've already seen the EU mention it before, although I will say Lagarde actually played that down at the last meeting. Switzerland have been named a currency manipulated by the US. They do intervene, and I think they will probably continue to do so. Some of these countries are going to find it difficult with much higher currencies. But it's, some of them on a trade weighted basis aren't moving that much. It is a broad dollar weakness issue, not specific to Australia or Switzerland. And that seems to sort of bring down the need to sort of do anything. We're not seeing massive interventions. A lot of it is talk, although we do get physical intervention from Switzerland from time to time. I don't expect anything physical from the EU at all at these levels, as in intervention, but maybe some rhetoric. And basically, the interesting thing about the recovery and sterling, if we do get a deal, if sterling does keep higher and keep going for a substantial period of time, there is a danger that actually impacts UK growth, which isn't great. So, you've got to be careful what you wish for. But sterling should do relatively well in the short term if we get a deal. If we don't, oh well, look out. Events for the rest of the week, usual thing on Thursday, initial jobless claims, keep a look at that. Really interested in that. I'm very interested to see what the BOE have to say. They got a rate decision meeting, 12 o'clock GMT tomorrow. But with no deal set at the moment, I'm not sure they can really decide to do anything. If we'd got a deal, if we'd had a deal earlier this week or last week, then I think they'd have been more hawkish. If we'd have left, I think they'd have gone negative with rates. So I think without a decision, then they're not going to be able to do very much there. So although you never know, but Bailey is very dovish, so be interested to see what he has to say about the economy at the moment. And on Friday, BOJ rate decision, don't see any change there. Press conference, blah, blah, blah. UK retail sales could be quite important leading up to Christmas. Could have an impact on sterling, but sterling's focused on other things at the moment, and it's Brexit. So data could just be a very short-term issue there. So German IFO is always worth a look, and Canada retail sales could move the loonie in the afternoon. And that's roughly where we are for the rest of the week. And I think that just leads me to pass over to Richard, who's going to look at the technical setup. And there's some interesting levels that we're at the moment. And he's the man to talk us through it. So I'm going to pass you over to Rich.
Great, thanks very much, Mo. Right, I mean, let's start where we normally start and have a look at the equity markets and see where we're actually sort of coming into play in terms of the important levels to monitor. And starting with the S&P on a weekly basis, yeah, nothing has changed. The positive trend is still very much in place. We're continuing to attempt to push to new highs. There's no evidence of rejections or sentiment changes, and the overall risk is for continuation to test these higher extension levels. So, we're nearing this first 138% extension of the August sell-off around the 37-33 area. That could be a bit of a focus. But again, if we start to break above that point, don't be surprised if we trigger some further upside moves, and then 38.22 would be the next extension level. But these are only sort of focus levels. They're not actually hard and fast resistance points. They're areas where the market could encounter some supply, some resistance. So it's more of a monitoring of the current activity. The reason why we feel that the general trend is still towards higher levels, again, Bollinger Bands continue to limit downside on the mid average. We're continuing to trade within parallel bands, so we know that this leads us to expect more of a positive trend channel. So in other words, in this situation, we'll trade between the support of the mid average and the resistance of the upper band, and continue to move higher, not aggressively, but within a more sort of positive trending condition. This was another example of when we saw that type of setup. It's when the bands start to widen that we look for a more aggressive acceleration move to the upside. We haven't got evidence of that just yet, but again, the overall risk seems to be more of anticipating the extension of the positive themes, and that can continue the overall sort of bullish backdrop. Again, we sort of bring on some of the other indicators, the momentum and trending indicators. The MACD still above its zero line, but more importantly and interestingly, with today's move, we're starting to see stochastics. If I can just bear with me and I'll bring that chart up, we can see that stochastics are just beginning to cross higher within what is still a positive trend. So effectively, we're now starting to see momentum turn up in a bullish trend. That can be a positive trigger for extension of this upside. Not expected to be aggressive because it's more of a balanced theme, but the overall risk is for momentum to come back into this move and technically for the market to try and extend the more positive themes. DAX, lo and behold, we have finally got a breakout. With today's price action, we've been holding this level for some time. We've started to break above that and obviously close above that. We've seen momentum come into this move. So again, the overall risk is still towards higher levels within the DAX index. FTSE as well, again, it's not an aggressive uptrend, but the overall risk is still skewed towards more sort of extension of positive themes and the risk to maintain this push higher within this sort of more positive trending condition and within the channel between the support of the mid average and the resistance of the upper band. So the overall risk, I think, is still heading towards more positive themes for the equity market. Now in FX, obviously, as Mo has said, the general backdrop for the dollar is still negative. We're continuing to see pushes towards sort of high levels, and euro dollar has broken out of this sort of consolidation area that we were referring to earlier and we've referred to over previous weeks, and the market now is sort of attempting to break to the upside. My focus now, however, is if we start to look at a trend line which dates back to September the 10th. So we're taking this high. We know that's quite an important rejection level because the market left a large upper shadow against that point, and connecting it with these two previous highs again where we started to see rejection coming in, and that is holding so far today. So basically we're tending to look at that trend line which comes in today around the 122.13 level as the next trigger point to the upside. So that would be my focus in terms of a resistance for euro dollar and a level that we would need to break above to maintain this push to the upside. But again, the momentum trending backdrop is still more constructive and suggests that we can look for further attempts to push higher, having broken to the upside. Kiwi dollar, we're continuing to, or I continue to see concerns technically for the Kiwi. The overall bias, the momentum seems to be coming out of the upside move for the New Zealand dollar. And I still feel that the risk is for underperformance to develop. Doesn't necessarily mean that Kiwi US dollar is going to sell off, because obviously the general dollar weakness that we have in place continues to sort of push or see attempts to push to new highs. But the Kiwi in general, certainly against the Aussie dollar, for instance, still looks set to come under further pressure. And we've broken above a retracement resistance level in Aussie Kiwi, and that still looks set to push towards to higher levels. And with that in mind, Aussie US dollar is still maintaining these more bullish themes. We're continuing to push higher, having broken from this consolidation. This is the weekly chart just to bring into play all of the long-term sort of failure highs as next resistance levels. 76.76 is still a focus to the upside offered by this rejection high. But again, the overall backdrop is still more constructive. So, Aussie is one of the stronger currencies technically within G10 at present, and the risks still seem to be that any weakness is going to be limited in time and extent. Dollar Swiss, again, we continue to make new lows. This is the monthly chart to bring in that, obviously the period where the SNB stopped the peg against the euro when we start. So we're running the retracement points off that move, and the risks still seem to be towards lower levels, around down towards the 50% point, around the 87.13 level. So again, the general negative dollar themes are still very much in place, with no real signs of this ending just yet, and the overall risk is still skewed towards further developments of US dollar weakness. So I think the overall backdrop is still one that suggests that the US dollar can come under further pressure. We're seeing other currencies that are beginning to lose momentum, such as the Kiwi, but the general trend is towards lower levels for the US dollar, and there still seems to be no risk of that ending, certainly with the backdrop that we have technically within equities at this stage, and the potential to extend more positive themes and test these higher extension levels over the course of coming sessions and coming weeks. But the general trends still seem to be in place, and with the risk still for extension over the Christmas period. So that's the technicals. I'm just going to hand back to Chris, who's going to look at your questions. Thanks very much, Chris.
Thanks, Rich, and thanks, Maurice and Nick as well. Somebody had a question for you, Richard. When approaching all-time highs or 52-week high level, generally, is that bullish, or would a rejection be expected? Or does the approach to that level matter as well?
Obviously the approach to that level is important, because we're obviously finding support within the market to attack a level that had previously held and has held for a significant period of time. The fact that it is approaching doesn't necessarily, I think it's a strong psychological level. If you've traded to that point and sold off and seen an aggressive sell-off from it, then the more significant people are going to view that area as a resistance focus. It doesn't necessarily mean that we're definitely going to correct from it or sell off from it. But if you're holding a long position and you're approaching such a significant all-time high, I would certainly be tempted to reduce risk into that level, because you can always re-enter the long if we start to see a break above that point, or if we see a correction to use as a buying opportunity, because it is such a significant focus in terms of resistance. You would anticipate some sort of correction back from it. If we break above it without any real sell-off, then again, that tends to strengthen the sentiment aspect for the market, and is potentially a stronger technical signal to extend the positive trend, as long as you continue to see the supporting signals from the various indicators to back up that break. But yes, you would expect a correction from it, but I wouldn't necessarily sort of view it as a potential reversal point, but it wouldn't stop me just reducing risk against it to see how the defense of that area materializes.
Okay, and once all-time highs are broken, what's the best way to look for new resistance? Is that fib extensions, or is there any other way?
You can, yes, I mean the obvious points are Fibonacci extensions. So in other words, you take the previous correction in price and project upwards from the all-time high by using exactly the same ratios that we have within Fibonacci retracements. So they, in a similar way to how we were looking at the S&P on the recent chart. So basically, we took that recent sell-off and the risk of the upside developing. We're using those extensions to highlight the potential area where you can encounter some resistance. It's not a hard and fast resistance, but it's just an indication of where, if you're looking to take profits, you can reduce risk against that type of area. But if we do see further support and then a break above it, then that would be a trigger for further upside. But within new high ground, it's really Fibonacci extensions that I would tend to use, unless there's a trend channel, for instance, which has an upper limit as a resistance level in new high ground. But the extension points are the main focus in that environment.
How do you feel? Somebody was saying, that the trend is your friend until broken, and I guess that holds true. That's the old adage. Do you think, as long as you're managing your risk correctly, then that really is that can be a very successful strategy, can't it?
Oh yeah, no, absolutely. I mean, I hate that phrase, but it is very true. And as long as you can establish the trend, and as long as you continue to see momentum and sentiment continuing to push towards higher levels, then that trend will remain in place. Obviously, every trend sort of climbs the wall of fear, if you like, in terms of everyone's looking for the turning point, having seen such a strong advance. But for me, the mantra really is, as long as sentiment and trending still point towards higher levels, then that trend is going to continue, and you stick with the trend. And that's where it's the acceleration phases higher in an uptrend or lower in the downtrend where the greatest profit potential is evident. And it's sticking, or it's establishing those potential acceleration periods and sticking with them, which ideally Bollinger Bands tends to highlight, that really offers you the best potential in terms of where you can expect the market to accelerate and extend that trend for a prolonged period of time.
So I've just pulled up the DAX for you there. You said that we're trying to break out from that line that you identified, that old high. Would you be able to just show us some of the that extension, or what you're looking at there potentially?
Yeah, basically, what you're looking for is to sort of measure the extension point. So you really need to see where the most significant last correction is in place. Now, obviously, we're not in new high ground with the DAX. We're still looking at these highs, but just assume that we're pushing towards new high ground. And we would still, even if we do take out these highs, if we're looking for an extension point, then we would be looking for probably this correction to really sort of act as the significant focus. So we would basically run the retracement points on that sell-off. We would then click on to, if I can see this correctly. So we would then basically look to adjust so we actually have the extension points in here. So I've literally just right-clicked on that trend line, or the downward sloping line, to bring up the box which shows all of the retracements and extension points. So really the only ones that I'm interested in are the 138.2 and the 161.8, because they're really the main Fibonacci ratios that we use within retracement points. So we basically check those boxes and it automatically draws the extension points on for you. So you can see very easily and very quickly where if we see an accelerating market, where the next resistance points are. So for the DAX, it would obviously be these old highs posted back in early February. But if we start to see those points giving way, then the next resistance would be the 138 extension at 14,272. So that would be the next sort of main resistance area as we start to push towards new high ground. If that starts to give way, then it would be the 162 extension at 14,774. So we would use these extension points as reference areas of where potential resistance could materialize within new high ground.
Thank you very much. Right, Nick, I've got one for you regarding the VIX. I'm just going to go back to your VIX chart at the start. And you were saying, I'll just pull that one up. You were saying about this, you know, the fact that as it's coming into year end, it's still remaining elevated, which is above this, you know, the 20 area. You know, part of that you said was down to liquidity coming into the year end. Do you think part of that as well is the fact that we've got the Senate runoff race for Georgia on the 5th of January? So the market's a little bit nervous around that because we're at a crossroads potentially for how much power Biden has to push through what he wants to do for the next 4 years.
Yeah, I think you pretty much nailed it there. Yeah, no, it's a major event for us, right? Because it's really going to determine how much, you know, certainly for the next 2 years until the next Senate elections in 2022. So this is a really big deal. You know, I don't think you can underestimate how important it is for Biden's chances to get a unified government here. So yeah, there's a lot of risk in there. You've got obviously year end, so we're starting to see, you know, we're really seeing the S&P and equity index ranges starting to contract. I think as people starting to look towards Christmas and activity starting to slow down a little bit. And there's a third factor that, you know, on many occasions when we're at one extreme or another, we quite often tend to see a reversal of that theme in the first period of the new year. So yeah, there's some elevated risks. I'm sure there are investors looking to have some protection against a potential reversal in the S&P.
So I know that you've been looking at this for other presentations, but do you think, you know, if Biden gets in, then you know, that's quite a big change in terms of, is it a big change of, you know, suddenly what investors, does it investor focus change? So suddenly they're looking at green stocks and maybe tech isn't quite as good because the Democrats might go after mega tech, things like that.
Yeah, I think you're definitely looking at potential for some sector rotation. So obviously, big oil is going to be under pressure as Biden administration would be expected to start to wind down the level of subsidies that they provide to the oil industry. So, you know, new drilling rights and lots of things, and he's got a stated goal of wanting to build up wind and solar and you know, green energy storage. So yeah, I think you see a little bit of a rotation. We're obviously already seeing, certainly with Tesla, we're seeing that benefit anyway. But this could be an additional boost to Tesla over time. I think a lot of it is already priced in, obviously, given the, you know, 600% meteoric rise in Tesla's price this year. But yeah, there are other solar companies out there that you can look at. Infrastructure, again, we're going to be looking at roads and bridges and new major infrastructure projects. Certainly here on the East Coast in New York, we've been looking at having a third tunnel between New Jersey and New York for decades, and they keep putting it off, and of course the price tag keeps going up exponentially. But they're still talking about that, and the Biden administration could actually give some government funding towards that kind of a project. So
they'll fund it from Mo's MMT, mate. Don't worry, they'll find the money somewhere.
It's basically, I mean, and you know, Mo's absolutely right. I mean, and that's the issue. They believe they can print money and stimulate the economy that way. But what happens when inflation comes around? There's some very interesting scenarios that are possible, and I'm very much on board with what Mo's thoughts are there.
All right, brilliant. So with that, that tees us up nicely for, starting again, and we can discuss that further as well in the new year. When we see you again, we're back now on the January the 6th, and obviously we'll have seen what the Georgia Senate election race will be there as well. So, potentially Nick could highlight some areas about where that will take us, depending on whether it's a Democrat win or the Senate still stays Republican. So have a great Christmas, have a great trading year end as well, and we'll see you all again bright and breezy in January. All the best. Thanks very much.